Well, hello, everybody, and welcome today to our webinar, just a market update. We thank you for joining us. My name is Greg Patterson, and I'm joined with my colleagues, Canady and Tara Gould, and we're excited to have you on the call today, really just to provide some historic perspective around where we are and to share with you guys some information that we think is valuable. So we're going to go ahead and get started. First, we want to just tell you what we're going to discuss today and take a look through a couple of things here. For example, we're going to talk through historic geopolitical events. Of course, if you haven't strayed far from your TV, you know there's the issue in Russia and Ukraine that I think is really unfortunate. We're going to talk and provide some perspective on that. We're also going to look at market returns and stock market volatility and talk about what you might want to do during this time period. And again, just to share some perspective on where we are. Also, the concept around diversification, and we'll talk about winning more by losing less and how principles of market diversification and investment diversification can help. We'll talk about growth versus value and how those have traded places, and we'll share some opportunities with you on that too. We'll look at bond markets and what those returns are and a forward look at where we see fixed income and of course the headwinds of inflation and the risks to that looking forward. And of course, everybody's seen that in prices rising. And lastly, we'll talk about our current situation, economic indicators, and where we see things. And then we'll provide a closing at the end and just share our conclusions around where we are. So with that, let's take a look just at a current S&P 500 chart. The S&P 500 is the US stock market. It has a $42 trillion market cap, and it's a combination of really the 500 largest companies in the US market. And so what you're looking at in front of you there is a chart showing from January 1st through today. And if you'll notice the top left-hand corner, it shows we're at a little over 4,500 on the S&P. And if you see the chart through March 8th, that was the low point that we experienced with basically a 13% drop. Year to date, however, prices have moved back up and we're slightly, we're right around 5% of a decline year to date on US stocks. So I bet if we took a poll, it would be interesting how many of you on the call today would have said we were, a greater decline than 5% for where we are right now. Certainly, the news headlines make it seem like it's a lot greater than that, but it's interesting that the year-to-date return is only off about 5%. So let's talk about staying calm amid market volatility. J.A., you want to walk through where we have been before?
Yeah, I'd be glad to. We were joking earlier in talking together that before Will Smith hit Chris Rock at the awards ceremony last night, that obviously Russia-Ukraine has been what's dominated the news headlines. Not to make light of that, but we don't really have our crystal ball to know where things are going to be, a week or a month or 6 months from now in terms of that, but we can look back at other events in history. And so this chart you can see here, the events are listed on the left. These are major events. So going back to 1939, Germany invading Poland, Pearl Harbor attack. So we're talking about world wars here. North Korea invading South Korea, Cuban Missile Crisis, Gulf of Tonkin, Soviets invade Afghanistan, Iraq invades Kuwait, September 11th. Everyone will remember the Iraq War. Russia annexes Crimea, and then that last line there, Russia invades Ukraine. And so the date on that was really just a little over a month ago, February 24th of 2022. And then on the right is just looking at returns, looking backwards from the date of the event. So 3 months before to the date of the event, what did the market do? You can see there the market was actually down 9% leading up to Russia invading Ukraine. If we were going to plug in a number there 1 month later, as Greg just said, the S&P year to date is down 5%. So better than it was even just a little less than a month ago. But I think the key here is to look at, the further we look out at these major, global events, you can see that there's actually some pretty decent returns. If you look out a year later, 12, 26%, 39, 12. There's a couple negative years looking out 12 months, but many of these are positive. And so again, we don't have our crystal ball, but we can look back and see as to how the market has responded to these types of events in the past. So there's some reasons to be optimistic, again, not knowing exactly where we're headed. This next slide we wanted to look at just takes a glance at how stocks have started out for this year, for year 2022. And it really stacks up alongside the 10 worst years for stocks for the first 2 months of the year. So January and February. And again, we're focusing on the S&P 500 index for these returns. But if we look at the end of February, the S&P 500 was down 8%. You can see there's other years in here where it was down more the first 2 months, some years where it was around that type of loss. But if we look at the returns the following 10 months, so again, this is not knowing exactly where we're headed, but we can look back at previous times when we've started the year down, how have the next 10 months looked? And you can see here, the next 10 months again have looked very good in many of these years, many of these times where we started the year off down. Here's 2022, down 8%. We've already recovered a little bit from that. Don't know if we've hit the bottom yet or not, but again, looking back on history, and there are some things to glean and learn from that. The average over all of these 10 years was down 9% for the first 2 months. But over the next 10 months, the average return was 28.4% positive. So again, I think this provides some good perspective and insight.
Okay, I'm going to take over for a little bit. More perspective on S&P 500 and returns. So what we're talking about here is market timing, trying to time when to get into the market and when to get out. And it is dangerous business, and we don't advise it. Here's some historical perspective. So what you're going to see first is decades starting 1930 and then through 2020 up to 2022. The first column for price return shows if you stayed invested from 1930 up until now. The S&P 500 has a cumulative return, 19,975%. But what if you tried to time the market? And the next column shows if you miss, and think about this in decades, if you miss 10 days of the best returns out of those decades, what your return will look like. And so the third column shows excluding best 10 days per decade, and that's each decade. You see your cumulative return at the bottom of 45%.
Wow.
Yeah, that's definitely eye-opening. Okay, and then the next one, we have win more by losing less. And so on the left-hand side, what you're going to see is just a chart of if you stayed invested in the S&P 500, like Greg mentioned before, top 500 companies in the United States, and you just consistently stayed invested for a period of time. And so our chart starts at 100,000, and this shows us in 2007. And so this would just be, you put $100,000 into the market at that time and just left it. And then at the end of the year, 12/31/21. So what happens is you rode the ups and downs over this period of time. And as of 12/31/21, you had over 400,000, so $408,120. And what we look at, we're going to talk about a little bit later, is just how we're approaching your portfolios. We are focused on upside, but what we wanted to show you here is we are thinking about the downside and that downside protection. And so this is showing us, by using different asset classes, what the end result is if we get some of the upside. In this case, it's 3/4 of the upside. But what if we could protect you on the downside? And so, same case scenario, we're starting at $100,000 and we invest. But instead of taking that full down, because we are diversified, and this is a case for diversification, we're protecting you on that downside. And so, just to highlight, the end result here is 12/31/21. We are higher as far as a dollar amount, $410,998. So this definitely supports diversification.
Yeah, and it's tough too sometimes, because we are looking at our statements that come every 30 days. And so we think linearly, if we add up the decline, well, gosh, by the end of 12 or 14 months, we're not going to have much money left, but it never really works out that way, as we've seen just in this first quarter of 2022. So diversification really does help put that in perspective on making sure we limit the decline.
Absolutely.
So here's something we looked at previously on a prior webinar, and some of you may remember this picture. So the mom's helping the daughter there. The mom is the Federal Reserve, the U.S. Central Bank, and the Fed has helped the stock market, being the daughter. Meanwhile, the child on the left hand was the value investor who was buying good, solid blue chip companies that paid dividends. Well, the stock market is more of a growth measure of those companies, and they're laughing and enjoying the swimming in the pool, so to speak. And so last year we definitely saw growth outperform value, but it's interesting in the last 3 months how that has shifted. And so if we were to repaint this picture or take this picture a different way, value is in place of growth and not struggling to keep its head above water. And I think it lends itself to a discussion of value investing, which is part of what we look at for you, our clients. And so this chart just gives a quick summary of value versus growth and the 5 best years of value outperformance. And so if you look to the left-hand side, you're taking a look at 1993. That was the best year that large value minus large growth performance happened, so 9.2%. But 2022 is the second best. And so it's important to understand, well, what is value? First of all, what constitutes a value company? And it typically is a company that is based on their fundamentals. They're priced within reason, and they pay a dividend many times. So a payment to you as the investor or shareholder to collect some income on your investment. And if you want to spend that, you certainly can take it off in cash and use that for a supplement. But many times you can reinvest and buy more shares to grow your value. So the chart on the right-hand side explains how value outperformance the rest of the year looks. And this is going back to 1987, taking a look at those 5 best years of value outperformance. And so while we're not sure how the next 10 months of the year looks, March through December, the average over time, over the last 5 best ones, is pretty good. I mean, it's 2% performance to the better. So there is some hope and opportunity there. And I think growth should not be tossed out, so to speak. But again, we made some changes most recently for our clients where we actually added 2 value positions and even put in utilities, which has been a favorable position with a dividend and also a commitment to paying that dividend over a long period of time. So I think that's important to take a look at and to understand where we are in that cycle.
All right, we next wanted to just address the bond market and fixed income. And we've known that eventually, for the last 2 years, we've been waiting for this time period in which the Fed will start raising rates. And it became apparent that that was going to happen starting this year. And so just the simple principle of, as rates go up, bond prices go down. We've known that this is going to be a challenging time when rates do start to go up, basically from zero on the Fed funds rate. The Fed did take action week before last with starting to raise rates. And we would anticipate them continuing to do that throughout the course of this year. And so navigating fixed income, where normally that's been a more conservative asset class to be invested in, there's additional risk in that because of the rising rate environment. And this slide, I'll talk more about that in just a minute, but wanted to call attention just to this slide. So we've had the second worst start of the year ever for bonds. And this is going back to 1926 to this year, 2022. And you can see there 2022 with a start the first couple months of the year down 3.3%. The note here is, on average, following the worst starts, the next 10 months saw bond returns bounce back. So we looked at this in terms of the stock market. This gives perspective in terms of the bond market and fixed income. So to the right, you can see the 10 years here where we've started off negative, with 2022 being second on the list. And then the next 10 months, how has the bond market performed? And this is going based on the US Ag Bond Index is kind of the measurement here. But you can see, actually, in all cases, in all years, the next 10 months have been positive. With the average downturn or loss of 2.5%, and then the next 10 months being up on average 5.6%. So we'll see that play out this year. We did just recently in our portfolio adjustments, we made some adjustments to hopefully mitigate the downside risk within fixed income. So we did things like making sure that we're short duration within fixed income. We don't want to be stuck in a lot of longer term debt that is more sensitive to interest rate movements than shorter term fixed income. So that, in addition to just making sure that we have a good balance of higher quality fixed income. And then we also, just in our portfolios in general, we have some targets in terms of the allocations between equities or stocks and fixed income. And so we pushed up to, we erred on the side of percentages versus fixed incomes within those different risk allocations that we've got. So those are kind of just that's a summary of the changes that we've made within fixed income here recently in our portfolios. But you can see here this graph of the 10-year yield, that we've seen a dramatic uptick in that 10-year yield over the last few weeks, up to almost 2.5%, which some folks had targets, year-end targets in the 2.5% to 3% range. So we've already jumped up to that. It lends itself to the question as to if we could be in this point of fluctuating back and forth, for the remainder of the year, or do we just bust through the projections for year end? I think that remains to be seen. But back to just to summarize it, we are going to be in a rising rate environment, and so we're maintaining watch over the fixed income piece of our portfolios.
All right, inflation, something that is on everybody's mind, impacting all of us. This puts inflation into perspective. So we're going back prior to 1970 and just seeing the year-over-year change in inflation. So CPI is Consumer Price Index, which is just the change in price of consumer goods. So on the right-hand side, we see at 7.9%, this is where we are today, up 7.9%. And then the gray column here is excluding food and energy. So this is what we call like the core CPI or core consumer prices. And just you can see that since for quite a long time now, inflation has been historically low. And so we've seen a recent increase in those numbers. And what I'm going to talk about next is I want you to remember this slide in the year over year increase, because JA, can you skip over to the next slide? So what this looks at is the amount of dollars that we have that is sitting in cash. So overall, this is quite alarming that the amount of US dollars still in cash or money market accounts, which are cash equivalents. And so what I really wanted to look at is what's the average rate of return on a money market account. And so according to FDIC, they are the depository insurance. If you've been into the bank, you've seen that sign at the teller that says FDIC insured. They did a report recently, and across the board average money market accounts, APY, so annual percentage yield, is at 0.08. And so we were just thinking about how do we put this number into real dollars? And so Greg was talking about a pack of gum. I haven't bought a pack of gum in a while, but I'm a mint person. But just looking at the average price for a pack of gum. So I was looking at Extra. I think Greg mentioned Trident, and so might like that kind better. But averaging around $1.20 in order to purchase this. And so what I wanted to know is how much do I need to have in a money market account at 0.08% to generate enough over the course of an entire year to buy that pack of gum? And the answer is $1,500. So if I have $1,500, I put it into a money market account, I step away, I leave it for a year. At the end of the year, I'm going to have generated enough interest in order to buy that pack of gum. So you guys can see here why we bring this up is because if inflation has increased year over year at 7.9%, and you have cash in your money market account, your dollars are not going to keep pace with inflation. Another thing that I think about is when clients are asking about and preparing for tax time. You get your 1099 in the mail and you're wondering why you didn't get your 1099 from your bank, from your money market account, your savings account, your checking account, whatever it may be. And the reason why is because for 1099s, for interest or dividends, the bank's not required to supply them. They're not going to generate them if you've earned less than $10 in that account. And so I think it's important to note this only is, I look at it from a standpoint of, okay, we got a lot of cash sitting on the sidelines, but also in a positive aspect of what could potentially be put into the market.
Well, and a lot of times, I know our clients have questions around, should I move money from cash into stocks and bonds or invest it to get a better rate of return? And even thinking back to the value investor today, the dividend yield is roughly around 2.5%. So if you're going from 0.08% of cash to 2.5%, you've just improved your situation dramatically. And that's not to say you put all of your reserve into investments, but you really should look at the opportunity that we've been presented with, a pullback in the markets to improve your rate of return in your situation. So what I wanted to share with you here is just looking at leading economic indicators. So the three of us sit down on a regular basis and talk about the state of the economy and where we are. And the conference board puts together every 30 days, and they track 10 leading economic indicators. So it's like looking out the front windshield of the car to see where the US economy is going or not going. and to help us make sense of the overall economic landscape. And what you're looking at from left to right is years. So looking at the late 90s all the way through 2022, so current, and you're seeing two different lines, red and blue. I want you to focus on the blue. That's the leading economic indicators. And then if you notice there's gray bars, there's actually three gray bars. The big one in almost the middle of your screen is the last major recession we had. Now, we had a minor recession with the pandemic in March of 2020 and some of that year, but it was a sliver, and you see that on the right-hand side. And notice how the blue line took a dip down. There wasn't much of a warning because the economy came to a complete standstill. So, basically in 3 weeks, the market sold off 34%, and we went into a recession at that point. But it quickly recovered back to normal, rising economic indicators. And while this isn't a crystal ball, it is pretty close to predict when the next recession is going to happen. But right now, we're still trending positive with those economic indicators. And these are things such as manufacturers' reports or purchasing managers index, wage growth, jobs, those types of things that are able to see out the front windshield of the economic car and just determine where we might be going with this. I think it's also helpful to take a look at it over a longer term, because generally the business cycle happens over 5 to 10 year segments of time. And here you notice that leading economic index goes from the 1950s all the way through 2020. And not always, but most of the time it does predict that recession, just a slight hair before the actual gray bars, which have been over that time period. So again, we try to help our clients to see where the economy is going and make decisions off of that, not so much as timing the market, but just general trends. And we feel like we're still in an opportunity for a growing U.S. economy as we look into the near term.
Something else that we do take a look at is this is put out by ClearBridge through Franklin Templeton, and they update this recession risk indicator chart. And so you can see here, this chart goes back over the last 3 months from month ending December to January to February. The items listed on the left are those indicators that are being analyzed, broken out into 3 different areas. But you can see here, housing permits, job sentiment, jobless claims, retail sales, wage growth, commodities, ISM new orders, profit margins, truck shipments, credit spreads, money supply, and yield curve. And if you can look here over the last 3 months, there really has not been change in these risk indicators, with the majority of them being positive, with the exception of wage growth, which wages have increased, but real wage growth, when you factor in inflation, has not kept up with inflation. So that's the reason for the negative X there for wage growth. And then money supply, we've talked about the Fed, but the Fed has been very, very accommodative up to this point, and now we're transitioning to this point of tightening. But the overall signal there at the bottom has remained positive with the upward green arrow, and it hasn't really changed over the last 3 months. This is a similar chart here, but it looks back over those time periods in the past where we have been in recession. So on the right here, you can see 69 to 70, 73 to 75, 1980, 81 and 82, 90, 91, 2001, 2007 to 2009, and then 2020 being the latest. But the asterisk would be by the 2021, just because it was very temporary and due to the restrictions on the economy from shutdown. And then you compare that to the current here. You can see during these times of recession, much more red, right? There's most of these were red during the recession risk indicators as compared to where we stand right now. So I think that provides some insight too in looking back over the past and comparing that to where we are now currently.
Well, I feel better looking at that chart, Jay, but I tell you, if you ever read the news headlines or spend any time at all watching the news, it doesn't feel good. Certainly with what's going on between Russia and Ukraine, and the headlines of the day would make you very concerned. However, taking a step back and looking at the actual economic landscape can bring some perspective to what's going on around us and some of the concerns that are out there that we hear from our clients every day. And granted, they are real concerns, but I think this gives a good perspective on that.
Agreed.
Okay, this is my case for staying invested even through volatility. So what we're going to do is we're going to take you back 40 years, so 19 into the 1980s up through the end of 2021. And what I want you to pay attention to here is the gray bars show the year-end rate of return. And so across the board, you're going to see positive rates of return by year end. And so taking a look at this, only 6 times during this time period were there negative year-end returns. At the bottom though, and this is really what we feel a lot of times, is the intra-year negative rates of return. And so you can see that each year you are seeing an intra-year negative rate of return. But what we want to encourage you is that historically end of years have been positive. And so if we even go back to something like 2020, and we had an investor sell out at the bottom of the market, probably thinking that, a lot of bad things are going to happen and there's no way that we're going to recover. But what you see is by the end of year 2020, we did have a positive return. So like Greg was saying, despite negative news, it is expected that throughout the course of a year, we are going to have a negative rate of return, and we encourage you to stay invested through that.
Yeah, I think about even just 3 weeks ago, we were a couple of weeks into Russia-Ukraine. There was all this uncertainty, all this fear about what was going to happen, and that was every conversation was kind of driven around that. But a couple weeks out from that, 2 weeks ago, we had the best week in the market that we had since 2020. So all of 2021, as good of a year as it was, we had the best week since 2020 2 weeks ago, which it just speaks to just the intra-year or intra-week or intra-month volatility that we see in the market over time.
Yeah, and it's important too to realize that the chart that you're looking at is 100% stocks. So S&P 500 is what these returns are based on, but most clients don't own 100% of US equities. They have a very broad-based portfolio. So the declines there, granted there were 6 times that you were down, but unless you sold, you didn't realize or book that loss, and you lived to see a better day. And even over time, your averages by this chart were over 15% average annual return. Even in a diversified portfolio, we're probably over 10. So just a case for riding out those intra-year declines like what we're seeing right now.
Yeah, and piggybacking off that conversation just around the uncertainty and the unknown and the fear of the future, I think it's kind of human nature for us to gravitate towards fear when we don't know what's going to happen, and that has been the case, right, with this whole conflict, the global conflict.
Right.
But there is, if we open up the Word of God, there is a place where we find peace in the midst of whatever's going on. And so we were just thinking about this verse or 2 verses from Philippians 4. Just I wanted to share. It just says, "Do not be anxious about anything, but in everything, by prayer and supplication with thanksgiving, let your requests be made known to God, and the peace of God, which surpasses all understanding, will guard your hearts and your minds in Christ Jesus." So no, in the midst of whatever it is, fill in the blank, there's a place where we can go to find peace. And we would encourage you to do that. Conclusions here. So we've hit on a lot of different things and topics, but we wanted to kind of wrap things up with these bullet points here. The first one being just that corporate profits for 2022 are expected to grow. So we still have positive expectations for, those quarterly earnings to come out for companies and be positive. Even though we're almost 2 years out from coronavirus, I guess we are 2 years out from coronavirus. We're still kind of in this recovery mode. And while we don't expect growth to be quite as robust as it was in 2021, we're still in a growth mode from the economy and from corporate earnings standpoint. Leading economic indicators are currently positive. We took a look at that, where we stand currently, and compared that to where we have been previously. That third bullet point there, continued volatility expected in equity markets. So kind of like we've experienced this year since the start of the year, the headlines of the day tend to drive the market one way or the other, right? Positive if there's a positive headline, or negative if there's a negative headline. And just with all that's going on, we would expect that volatility to continue, even in light of the projections for growth from an economy and a corporate profit standpoint. Just because there's volatility doesn't mean the market can't continue to go up. It just means there's more ups and downs, right, as you continue to do that. The Fed continues tightening, so that's already begun, and we would expect that to continue throughout this year. There's some folks say we'll have 6 rate increases for the year, maybe end the year up close to 1.5% on the Fed funds rate. But there's question marks even about the next rate increase. Is it going to be 25 basis points? Is it going to be 50? How quickly should the Fed raise rates? What we do know is that they are going to be raising rates. And so we're managing, investments in portfolios, knowing that that's the case and trying to manage around that. Inflationary headwinds continue through the year as rates are increasing. We see inflation right now currently with the producer price index is slightly higher than the CPI. So we looked at the CPI earlier in the presentation, which is the price that consumers pay. The PPI is the price that producers pay, or the suppliers. And so with that being right around 10% instead of 8%, we could see the consumer price index tick up some before it starts to level off and go the other way. So that would not be surprising. We do not expect to continue indefinitely at 8% though on the rate of inflation. So we see it as a headwind this year, but we would see it not continuing at the 8% level for the long term. Rates on cash rise, but real returns remain negative through the year due to inflation. Tara talked about this, but those monies that are in money market or CDs or savings accounts, you may start to see some higher interest paid on those, but still in light of inflation, you'd still be in a position of losing purchasing power. You're not going to keep up with the rate of inflation where it's currently running with money sitting in the bank in those types of accounts.
Well, and the misnomer, I guess, on that is you're never going to get a bank statement that shows a negative real return, but you have to realize that's the risk. Even if you're older and retired, the risk is it takes more dollars today than it did yesterday. So to earn less in cash would be, you would be losing money. Mm-hmm. So if you have questions, you can feel free to email any of us. Just put our name. So Greg, J.A. and Tara at myatlanticwealth.com. That's MY, Atlantic as in the ocean, wealth, WEALTH.com. And we'll be glad to respond to you as soon as we can. Also, if you're on this call and you're not a client and you'd like to have an opportunity to sit down with us and see how some of these concepts might work for your situation, feel free to reach out to us as well. You can call us 252-515-7800 and schedule an appointment, or email. Again, either one of us would be glad to respond to you. Just put our name at myatlanticwealth.com and we'll get back to you to set an appointment. Really just to sit down with you, get to understand your situation and find out where you're going and what we might be able to do to assist you. If you're a current client, we have made changes and we've communicated with you through email and to explain our rationale. So hopefully you got that, you look through it. We try to keep our emails to one page, knowing that you get a lot of communication from many sources, but this one happened to be longer than that. If you have questions how it relates to your specific situation, please let us know. But we're taking action on your behalf to help you. And we do value and appreciate you as our client and as our friend, and are looking forward to getting through this together. And we just want to encourage you to stay focused on what matters most, your family, your faith, keeping things in proper perspective. And if you find that you're a little anxious, it might help to turn off the news and realize that there are those around you who care about you and that you can impact their lives. So we thank you for the opportunity to serve you and be your trusted advisor. And I welcome and look forward to the opportunity of seeing you again soon. Thanks and have a great day.